I do think that, yes, I still maintain a gold ascending warning because I keep going back to gold is a non-correlated asset. So to the extent that big money is concerned, they're concerned about something that is making them want lower average portfolio correlation. So there is some, I think, smart money that is concerned about something, and gold being its historical risk off, price behavior benefits from that. Either way, even if you don't have something cataclysmic, gold is due for outperformance because I think you can say pretty confidently, we're headed back into a negative real interest rate environment. And gold does well in negative real rates where inflation is higher than the cost of capital. So I think, if anything, the gold move is anticipating that, like it or not, the Fed's going to lower rates with inflation still up there.
So let's combine the last two pieces of our conversation between AI and this sector rotation. So, Michael, NVIDIA has a $3 trillion market cap. What happens when this cycle is over and a percentage of that market cap rotates out of NVIDIA and other AI investments and into sectors such as commodities, gold, silver, miners, things that we need for the next cycle? Those sectors, they're so small in comparison.
Yep.
What do you expect to happen there? Or are you not anticipating a rotation into those sectors? Or are you expecting it to go somewhere else?
Okay, so first of all, typically rotations happen within an asset class, not necessarily across. But the point that you're bringing up is valid, which is that there is a lot of potential for the commodity sector in general because of underinvestment. And by comparison to most other things, it's still relatively small, which means it wouldn't take much money, not even a reallocation, just money going into the commodity space for that to move, right? So and the reality is any kind of AI future, anything on the tech side is going to require, commodities. It's going to require all kinds of things to kind of build out that infrastructure. Right. I mean, for God's sakes, you can't really have AI unless you have nuclear. I mean, in the extreme. And
we're going to talk about nuclear here in a moment.
Yeah, and we're years away from mass, adoption. Let's call it on that end. Right. Even with the small modular reactors. So I guess the point is that I do think the commodity space is long overdue. I do think for commodities to run, though, you need to have some kind of bottoming in China's economy, which I think we may be in the process of. I know the last few weeks the data has not been that hot, but the markets actually look decent when I look at China's markets anticipating what could be coming. Any kind of a marginal reacceleration of China should be bullish for copper in particular, for commodities overall. And if that's the case, then that will complicate the inflation picture because if commodities start to suddenly have another run, now we got cost push inflation to worry about, and good luck with the Fed cutting rates aggressively then.
Goodness gracious. Well, a lot of people are saying that we're going to see inflation in the things that we need and deflation in the things that we own. So,
yeah, honestly, that's been the case for a long time, though. I mean, it's nothing terribly new. I mean, you see it on the healthcare side, on the education side. It's a very odd environment from that standpoint.
Yeah, fair enough. So is gold sending us a warning by breaking out of its 4-year consolidation zone and blowing through the all-time highs? And if so, what is that warning? And do you consider it to be the start of the next gold bull run?
So I had put out that post ominously repeatedly when the breakout started taking place, gold is sending a warning. And I think initially it was because of concerns around Japan intervening with the yen, which then happened after gold's move. And then you had that momentary fear of World War 20, I think it was, right, between Iran and Israel. Right, I forget what number we're at now as far as the concerns. I do think that, yes, I still maintain a gold ascending warning because I keep going back to gold is a non-correlated asset. So to the extent that big money is concerned, they're concerned about something that is making them want lower average portfolio correlation. So there is some, I think, smart money that is concerned about something, and gold being its historical risk off, price behavior benefits from that. Either way, even if you don't have something cataclysmic, gold is due for outperformance because I think you can say pretty confidently, we're headed back into a negative real interest rate environment. And gold does well in negative real rates where inflation is higher than the cost of capital. So I think, if anything, the gold move is anticipating that, like it or not, the Fed's going to lower rates with inflation still up there.
So the last two big gold bull runs, the 70s and the early 2000s, they both lasted about a decade. Are you seeing a similar time frame for this one? And do you look at it as having started around 2015, 2016, or do you look at it as having started at this breakout point?
I say it's more around this breakout point. As far as time frame, it's hard to really handicap that. I mean, certainly if you're a big believer in these sort of long cycles, then yes, you could see a multi-year period. In general, when you have a long period of nothingness and then a move higher, the initial feeling is that it's skepticism. It's like, oh yeah, it's interesting, gold broke out, but anecdotally, I don't see the excitement around gold the way I used to see it around the top in 2011, when the gold bugs were as vitriolic back then as the Bitcoin maxis are today. Right, and you can't quantify that, but it's just my sense that the best uptrends are built on skepticism, and there's still a lot of skepticism. And as long as that skepticism persists for many years, then gold will probably likely rally for many years.
Yeah, I would agree with you on that, and I see it too, and I hear it from a lot of the other folks that I'm interviewing. They're saying exactly the same thing. So, Michael, let's discuss something that's near and dear to your heart: the gold to lumber ratio. Would you briefly describe what it is, its value in analysis, and what this ratio is saying to you currently?
So it's no different than lumber to gold. Than copper to gold, right? As a sort of tell on, risk off dynamics. Lumber is tied to housing starts, right? Because of construction. Gold is the quintessential risk off play from the commodity world. So you compare lumber to gold, it actually tells you a lot historically about volatility changing. When lumber is doing better than gold, that tells you that housing is likely picking up. That's positive for liquidity, risk on sentiment. When gold is doing better than lumber, it's the opposite. Lumber has been incredibly weak and gold has been incredibly strong. It hasn't mattered as a signal yet, right? But it's very clear that there's a message there that housing is likely going to decelerate pretty aggressively. And if gold is sending a warning, then there's just a lagged effect that is still yet to come as far as that volatility spike, which I think it's anticipating. So depending upon the time frame you're looking at, it's basically sending a risk-off signal here. And again, it should make sense because housing is due to weaken, given delinquencies rising, given a stretched consumer, given the lag of the fastest rate hike cycle in history. So, and what may be actually some overbuilding, right, from the home builders, right, because they were responding to supply being as tight as it has been. So yes, I do think that it still has merit as an indicator. It's just taking some time to sort of really prove itself here. The question becomes, if lumber to gold is telling you of risk off, then how do you play it? I keep going back to gold seems to be itself the way to play it until treasuries pick up the ball.
Yeah, and I think, in today's social media world, even versus the last cycle where we did have social media, but things just seem to be so much intensifying these days, and the scrutiny over cycle moves, people are expecting it to happen in such shorter time frames, but it's just not realistic. That's not how it has played out in the past. So with the AI explosion requiring massive data center build out, the electrification of everything, the boom in solar panels, the rising advanced weapons manufacturing that is happening globally, and all the other factors tied to it, silver demand is really rising and steadily rising. This is at the same time that supply is flat, leading to a fourth straight year of extremely large supply deficits. During this entire time, the price of silver has been hovering around 30. Well, really in the last couple of months, around 30, which hasn't really been seen since 2011. What's your position on silver?
I would probably prefer gold over silver, but silver should participate. I mean, aside from the fact that there's a historical relationship there, I go back to my comments around China, right? If China potentially reaccelerates, silver as an industrial play should also benefit. The electrification point is a very valid one from a longer-term tailwind perspective. I'm just not so sure. Look, I mean, you don't have to choose one or the other, right? I mean, you can just play both of them and overweight one relative to the other, or just equal weight them. But am I bullish on silver? Yeah, sure. Am I bullish on gold? More so. Am I bullish on volatility? More so. But all these are connected.
Okay. So, Michael, the gold and silver miners, they've had a very rough last couple of years, to the point where
Yeah.
many experts and analysts who have recency bias, they're suggesting that the miners will not come along for a rally in gold and silver. That's really never happened in a gold and silver bull rally. In fact, when gold and silver are in a sustained and strong bull run, the miners' torque to the underlying metal produces breathtaking returns. What does your analysis point to for the miners in this precious metals bull run? Will it compare to the 70s and early 2000s in your estimation? Will it look different? What are you expecting in this bull run?
So I've put out that comment before that I think the miners are stupid cheap. Just fundamentally, they are stupid. Now, of course, cheap can stay cheap for a long time. So it's like, what do you do with that information? I think the nuance is going to be how oil plays into that, right? Because I've done a lot of back tests on this. Gold mining stocks tend to not correlate as well to gold as they do tend to correlate to oil, because it's very energy intensive to get the stuff out of the ground. So having said that, I think the miners, if you're going to play them, you want to play them by just sizing it appropriately, because they are volatile. Right? It's among one of the more volatile, less sort of trend happy type of places of the marketplace to try to position into. So I think if you're going to do it, you size it appropriately. I would still probably prefer the metals directly as opposed to the companies themselves. And I think if you're going to do the companies themselves, you're probably better off doing an ETF or a diversified fund of sorts. Stock picking is hard. Stock picking in the mining space, probably especially hard.
Fair. So we've been talking about energy and commodities and the lack of investment over the last 10 plus years. There's been a $3 trillion plus CapEx investment shortfall over the last decade plus in all forms of energy. While at the same time, the AI data centers are getting ready to suck so much energy between now and 2030 that some are saying they would equal the 9th largest energy using country in the world.
Yeah. Yeah.
Add to that the electrification of everything else and hundreds of millions of people around the globe being raised up from poverty into the consumer class, and energy utilization is set to dramatically expand. How do you see the quickly growing global energy needs being met, and what do you see happening to energy prices in general?
So it goes back to that point about, what am I bearish on? Bearish on the time frame, because you got to build all this stuff out. It's, to your point, you don't have it there. And so I've made that argument before that, if you're really going to play on the long-term future of AI, you're playing on the long-term future of nuclear, right? Because that's really the only answer if the electricity demands are as high as they seem to likely be. So yes, it will take a longer time than people realize, because I don't care how many data centers you put up, you still got to power the stuff.
Right.
It's like, what's the bottleneck to AI? It's not NVIDIA, right? It's clearly not NVIDIA. The bottleneck is what's going to power it.
Yeah, that's good. All right. So, Michael, let's discuss nuclear energy. You touched on it a little while ago. AI data centers, they're expanding rapidly. They use immense amount of energy. Countries around the world have collectively done a 360. They're now saying that they're turning back to nuclear, or they're going to nuclear for the first time to meet their growing energy needs. And this was after, I don't know, a decade and a half of them just completely pounding it as the redheaded stepchild. The price of uranium reflects this, as last year it rose from about 30 to 100, and it's down in the 80s, but it's significantly elevated off its low. Those who are paying attention to the sector, they also really understand the supply and demand story, where there just is not enough supply, and there won't be for years and years and years to come. Do you see uranium as an important long-term play that everyone should have as a core component of their portfolio? And with the sector being so astronomically tiny, what do you see happening as the prices stay elevated for the long term and more investment dollars rotate into the sector?
Okay, so I think short term it's vulnerable to pullback just because it's done so well. I think long term the case is very real, right? So if you're a real long term investor, you wouldn't care about what happens in the here and now. Do I think it should be part or can be part of a core portfolio? Sure, as long as it's appropriate for one's risk tolerance and time horizon. Nothing is guaranteed in markets. I think the case for uranium and nuclear is as close to guaranteed as you can get without getting into trouble. right? I'm barring some dramatic new energy source that out of nowhere, which you never know, could happen, right? Just ends up blowing everything out of the water, and you have a new renaissance because it's coming from grass. I don't know, whatever, something else. But I do think, yes, there's a lot of, to your point, it's a small area of the marketplace. It's very consequential. It's going to become more important, and it's probably better off. You're probably better off positioning now before it gets too crowded in general. But again, I think there's a difference between short-term and long-term. Short-term volatility could be painful. Long-term case is unequivocally there.
Anybody who's been in the uranium space for any length of time has experienced that painful volatility, so they understand what that feels like. So you mentioned copper earlier. There are many analysts who are talking about a massive copper supply deficit that's starting around 2026 and going into the 2030s. It takes, by some estimates, 20 to 25 years to get a producing mine. There has not been massive new discoveries over the last 10 years that is going to point to massive new mines coming on. Some are saying we need 5 times more copper to meet the needs moving forward. What is your copper thesis? What are you seeing there?
Yeah, I mean, you're probably closer to it than I am, but I've seen similar stats on that. It's not just copper. I mean, this is what happens after you have an underinvestment for many years in a lot of commodities, especially in an era where there's been such a focus around green energy and climate change policies and the demonizing of a lot of commodity companies in general, right? So, I mean, all this has resulted in a dislocation of the timing of new supply relative to the demand hitting at that time, right? That's not unusual. I mean, this is probably far more accentuated than historically it has been, right? These cycles. And that's, again, it goes back to why, yeah, there is a very bullish case for commodities from a longer term perspective, because the best returns come by investing where everybody's underinvested, almost by definition, right? It's because the payout is higher when there's fewer other people betting on the same pot. So yeah, I think that, again, you're closer to this than I am, but that would not shock me at all to see that supply-demand mismatch start to really get priced violently into copper.
Interesting. Okay, so what trends are you watching out for to play out over the next year or so, and why would that trend or trends be important to both the economy and the markets?
I think the main, which is related to the value versus growth, I think the main trend should be, or will likely be, will you see money start to favor dividend, cash flow, income producing assets, or continue to favor momentum, capital gains type of momentum? We've been in the latter, right? That pendulum always swings from a total return perspective from cap gains to dividends, dividends to cap gains. So it's been much more on the cap gain side. I think if the uninversion of the yield curve combined with delinquencies and all these lagged effects hitting all at once means we're in for more volatility ahead, then there should be more demand for blue chip safety through dividends, right? So if you start to see more of that relative strength kick in, as I think it's starting, that becomes sort of the next major secular play, right? Separate from commodities, it's more of a sort of a feeling that we can't just go off of hype anymore. We have to go off of stable companies that have a history of paying shareholders.
Interesting. Well, this has been a fantastic conversation. Before we wrap up here and I ask Michael our final question, I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and every single expert interview that we conduct, just like this one. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com and put in your email address to subscribe and receive this free gift on us. Also, I'm positive that you've enjoyed this conversation with Michael as much as I have. Please let him know. Hit that like and subscribe button and leave a comment below the video. It's now time for our Golden Nugget segment. Michael, let's discuss portfolio positioning. Based on all we've discussed today and with your experience and worldview as the backdrop, how are you positioning for the next 12 months? What assets do you like and what assets do you absolutely want to stay away from?
A little biased, but the assets that I like are my own funds as a portfolio manager. I mean, that's where my own capital is tied up, my mutual fund ETFs, which I had a hard time because they rely on treasuries to be the risk-off play.
Please share them, and I'll put the symbols up right here in the
video.
I
appreciate. I mean, again, the caveat that they have not performed well. They're rules-based. They've had a hard time because they have to be in treasuries when in risk-off mode. In the worst bear market for treasuries in history, it's been a very difficult last few years. But it's a cycle question more than anything else. ATAX is the mutual fund, ATACX, RORO, my risk-on, risk-off ETF, and then JOJO, junk-on, junk-off. But in all seriousness, I mean, aside from that, I'm bullish on volatility rising. I'm bullish on uncertainty. I think I'm bullish on complacency getting reversed, right? So if you are of the same mindset, the question then becomes, how do you position for volatility? It's not by going into VIX products. It's by having much more correlation, which means probably having gold, probably having treasuries, probably having commodities, probably having defensive sectors like utilities, consumer staples, and healthcare. It's just having a much more diverse, low volatility mix overall. It's not a directional call. I just think that we are due for that complacency to reverse. And when it does, better to be prepared before it happens, because when it happens, by the time you notice it, it'll probably be too late.
All great points, and I appreciate you sharing that. Michael, thank you for coming on to the Metals and Miners podcast, for being so generous with your time, your analysis, and ideas. It's really been incredible to spend this time with you. Would you please share with the viewers, what is the overall theme that you want to leave with those tuning in? Where can they learn more about your work and how they can connect with you?
Yeah, I appreciate that. I mean, I'm available on most social networks under @LeadLagReport, X, YouTube, Instagram, Threads, LinkedIn. I think the main takeaway is just, just don't get complacent, right? It's been a nice run. I mean, that's been the theme. It's like, don't keep on gouging and getting heavier and heavier. Start fasting for your own portfolio, because there might be some leaner times ahead. So it's, I often go back to the analogy of, you don't know the mile marker you might crash your car when you're driving, but you know that when it's raining, you have to slow down, right? My argument would be that it's already raining, right? There've been periodic moments of sun, but for the most part, you're due for some kind of a storm. If you're due for some kind of storm, it doesn't mean you get bearish by shorting. It just means you position differently. Yeah. And the good news is it's still early.
I really like the analogy about fasting. And, oftentimes you hear about, don't pick up the extra nickel in front of a bulldozer. People have really gorged out at the top here with NVIDIA and the tech plays and the growth. And, they could really give a lot back very quickly if they're not careful, and lose a lot of the opportunity that's going to be coming into the value side. So I really appreciate you sharing that. Everybody go follow Michael. Not only is he filled with a lot of great information and analysis and ideas, and, especially with his background, but he's also hilarious, and he's just somebody who's fun to listen to. He's got a great personality. Michael, I look forward to having you back on. Thank you for being here with us, and everybody else, thank you for watching.
Appreciate it.
I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and every single expert interview that we conduct, just like this one. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com and put in your email address to subscribe and receive this free gift on us.